G'day and welcome to this week's video. My name's Robert Gowdy. This week we're going to have a quick chat around young people and investing. And I'm going to draw on some of my experiences and what I've seen here in the business, where we deal with probably only a handful of really young people that have been investing for a good amount of time and have been saving well and have done extremely well. In a world where there are so many distractions, where there is so many ways for us to spend money, there's so many ways for us to spend money we don't even have. When you think about buy now, pay later, credit cards, Afterpay, Zip Pay, there are so many ways for ourselves to get into debt and into strife. And all that can be done from a phone, as we all know these days. So I thought it'd be valuable to have a look at what these young people are doing and how they've become so successful in a very short amount of time. So probably the first thing is a savings mentality. If you don't have a savings mentality where you take the approach that you're going to spend less than you earn, then you're not going to save anything, and if you can't save anything, then you never have the opportunity to invest. So they've got a savings mentality where the money they earn, they're very protective of it, so they don't waste. They start early, and I'll show you, probably to finish off the video, the benefits of starting early and compounding interest. So the earlier we start, we have the full effects of compounding interest over obviously a longer time frame, and it makes a monster difference to the end result when we hit 50, 60, 70 and retirement. So they start early. The savings they get, they're invested. So they're not just saving money and leaving in cash, because ultimately cash will, doesn't provide a product or a service. It will do nothing. When we put money into the banks will take that money, and they're in the business of lending it out and making a margin, making a profit. So if they're paying you 1.5%, 2% on a term deposit, they're lending it out at 3% and 4%, and that's where they're in the business of lending out money, and they're making a profit on that. So they're not leaving it in cash. They're building up a nice buffer, and I think it's always important to have a nice backstop of money for that rainy day or something goes wrong, but the money over and above that is invested. Where do they invest? Well, they invest into businesses. So particularly my clients, where we've seen some phenomenal results, and some of these people are not quite 30 and they've got portfolios worth $300,000, $400,000 and $500,000. Has been they've invested into businesses, generally under advice, which has worked really nicely for them, and those businesses have gone up in value because the profitability have gone up, and that's driven the share price. So they've had a bit of good luck, a bit of good management, and they've just held the businesses for a long time. And to this point, I doubt they'll sell them at all. They don't use debt, so they avoid credit card. If they don't have the money to buy it, they're not going to take on debt, to fund it. So quite conservative in the way they're thinking. But when you think about investing in the share market, investing into businesses, that part's probably not quite conservative. They're just very picky, what they spend their money on, and they will not use debt to fund that, because they know that the debt's going to, if it's credit card debt, it's going to cost them 18% per year. So an absolute nightmare. And as I mentioned, they don't waste money. That is absolutely vital. You don't waste money on stuff you don't need. And unfortunately, when I look at my Instagram feed or whatever social media you're on, the amount of things that you can buy, it is so convenient. The Amazon transactions, all off the smartphone, it is so easy. So they don't waste money, they don't buy stuff they don't need. So the benefits of starting early can't be understated enough, or overstated enough. So you can see here some different starting ages, so 30, 35 through to 55, and if you want to get to $1 million by age 65, you need to invest $7,234 per year to do that at age 30. If you wait 5 years, that's got to be $10,500. If you wait another 5 years, it's nearly 16, and so on. So it just becomes harder and harder, the longer you wait. And it's compounding interest that does the trick. It's money being earned on top of earnings, and the compounding effect of that. It's what has made Warren Buffett the investor he is now, as well as all the other smarts about choosing what businesses to invest into, avoiding debt, and doing it from day one. So this is what I'd recommend for young people is start early. Save money first, start early, invest into businesses. And you can do that via very cheaply. You don't need lots of money. You can start with as little as $500 plus brokerage, which can be as little as $20, through one of the online brokers. So get stuck in, start now, don't wait, and you'll thank yourself 20, 30, 40 years down the track. Thanks for listening. Please hit a lot of the resources down in the description area there. There's lots of information and free education for you. So hope you enjoy, and we'll speak to you soon. Bye.